Hello everyone and welcome to this video capsule. Today's topic is finance. Together with my colleagues Dorian, Loic, Bart and myself, we're going to analyze the company Solvay. Our main goal is to present the firm's valuation using the DCF model. To get there, we will start with a short overview of the company and its industry. Then look at its strengths, weaknesses, opportunities, and threats. Next, we will cover Solvay's ESG practice and position and highlight its equity story. Of course, we'll also include financial analysis and an event study, all leading to the DCF valuation to see if the company is fairly valued. Solvay was founded in 1863 by Ernest Solvay and is a historic leader in the chemical industry, especially known for soda ash. Today, Solvay operates in 41 countries with 44 production sites, and it employs around 9,000 people. Solvay focuses strongly on sustainability and innovation. Be careful in 2023, the group went through a major transformation, splitting into two companies. Syensco focusing on specialty materials and Solvay now dedicated to essential chemical and environmental solutions. Regarding the chemical industry, it had a turnover of 5.2 trillion euro in 2023. The basic inorganic chemical segment, where Solvay is active, makes up 14% of the European market. It's a strategic and oligopolistic sector with a strong demand from energy, automotive, and electronics, for example. Main challenges and opportunities include strict environmental rules, green innovation, geographic expansion, and merger and acquisition. Finally, the four closest competitors to Solvay are shown in the table below. The group ranks fourth in its international market and first in Belgium. I now hand over to Bard. Now, in terms of ESG, Solvay score dropped from 81 to 73 in 2024, mainly due to lower performance in resource use, community impact, and shareholder relation. However, the ESG controversy score improved from D to B, meaning fewer negative media issues. Despite this, Solvay ranks 49 out of 427 in this sector. Compared to its closest rival, is in the middle, not the best, but not the worst. And in terms of controversy, Solvay still lags behind. Finally, Solvay will face stricter carbon rules soon. Free CO2 quota will drop by 4.4% each year until 2030. This could raise costs, but Solvay is already reducing its emission, which is a good thing for both the environment and the company's value.
After the 2023 spin-off of Syensqo, Solvay repositioned itself as a pure player in inorganic-based chemicals, a capital-intensive industry with limited substitution risk and strong barriers to entry. Our SWOT analysis highlights key strengths: a solid industrial footprint, strong integration upstream, and an expertise in soda ash and bicarbonate, but also weaknesses, especially its exposure to energy prices and a damaged ESG reputation from past controversies. The Pastel framework shows pressure from stricter CO2 rules, geopolitical tensions, and supply chain uncertainty, but also new opportunities, like growing demand for low carbon materials. In this context, Solvay is moving fast. The group has launched over 90 decarbonization projects, including a new e-soda process that cuts CO2 by nearly 50%. It also applies an internal carbon price of nearly 100 euros per ton, well above most peers, helping it guide capex decisions and reduce long-term risk. From a valuation perspective, Solvay trades at a discount 5.8 enterprise value over EBITDA versus 7.2 for Evonik or over 8 for Sumitomo Chemicals. This reflects investor caution, but also leaves upside potential if Solvay delivers on its low carbon strategy. While some competitors are catching up, Solvay's early positioning and strong execution give it a chance to lead in decarbonized production, especially in Europe. If successful, this could support stable margins, market share gains, and long term value creation. In a sector where ESG is becoming a key buying criterion, this gives it a potential long term advantage if execution remains strong.
So now we speak about the financial outlook. So on the left, we see Solvay's EBITDA and net profit margin. EBITDA is stable around 20-25% of sales, and net profit drops in 2020, then increase sharply in 2023 before falling again because to the spin-off of Syensqo. On the right, we see Solvay's ROE compared to competitor. In 2023, Solvay's ROE jumps to over 150% of sales, which reflects strong profitability before the split. But after that, ROE drops sharply because of the Syensqo spin-off, which reduce Solvay's equity base and earnings power. Then about leverage rate and debt repayment. On the left, we see how much debt was issued and repaired from 2015 to 2024. There was a lot of debt in 2015, then it stays stable except in 2020 and 2021 when the companies repay more than they borrow it. In 2023, debt increases again, maybe for the new investment. And now on the right, we see the leverage ratio of several chemical companies. So we can see Solvay stay stable until 2022. Then its leverage jumped in 2023. Dow also had a high leverage around 2020, but it went down later. Mitsubishi and Albemarle had low and stable ratios. They use less debt. So now we speak about the event study. We analyze 4K dates between 2019 and 2022. The first event was on the 7th of May 2019. Solvay say its profits would be lower than expected because demand was weak in important sectors like cars and electronics. The stock price dropped by 8.5%. Then the second event was on 27th of March 2020 during the COVID-19 crisis. Even though the CEO say demand was rising in healthcare, investors were scared. This panic caused a strong negative reaction in the stock price. The third event was on 23 of November in 2020. Solvay sold some less profitable businesses. Investors say saw this as a smart decision, and the market reacted positively. Then the fourth event was in January 2022. So Solvay made a new partnership to create an eco-friendly carbon fiber and also won a patent case. So it is two good news increased investor confidence and the stock price went up.
Then several events catch our attention. For instance, in February 2022, Russia enters in Ukraine. All of that creates geopolitical instability, for instance, with energy price increase, and create uncertainty among investors. It creates a cumulative annual return of -5% during this period. Then there is the 12th of December 2023, when Solvay demerged its activity between two entities, Solvay and Syensqo. Solvay in order to leverage the profitability, the margin, the return on asset of the group. And at the same time, there is the unveiling of the e-Solvay process, which aims at reducing the energy cost of producing soda ash and at the same time reduce emission linked to this process, and it generates a cumulative annual return of 10.4%. And then there is in March 2024 when Solvay successfully completed a 1.5 billion euro raising bond, and it creates a cumulative annual return of 4% for that period. Finally, we have developed a model in order to determine the true value of Solvay for the investors. In order to do that, we use a discounted free cash flow model, and we have made different hypotheses. Hypotheses about how the sales of the group will evolve, hypotheses about how the group will emit more emission in the futures and will pay for this emission, how this emission will be reduced thanks to the Solvay process and all the different efforts, and also the evolution of the quotas. And we also take into account some other factors like the investment of the group, the capex, the capital expenditures for the energy transition that will evolve with the different legislation that will take place. All of that are developed into the report. Based on all of these hypotheses, we are able to construct this table that try to project all of the financial components of Solvay up to 2034. Based on that, we are able to compute the different free cash flow on Solvay, free cash flow that we will discount in the next slide. So if we look deeper into the free cash flow of Solvay, we can quickly understand that the group will hit a high of 475 million euros by 2008. Then it will decrease up to 2034. If we compute the asset value of the group, the net asset value, you can estimate it to be 3.4 billion euro instead of 3 billion euro estimated by the market, which represents of a 14% discount. According to us, Solvay has a lot to offer to the society, to the development of the society, that it is a bit more valuated than what the market do. And so recommendation is to hold or to buy some Solvay stock in order to benefit from this discount. And that's it for that presentation. I hope everything was clear for you, and thank you for your attention.